We begin with an introduction to cash accounting. Okay, let's take just a second to introduce the overall purpose of accounting for cash. And that is to make sure that we've accurately recorded both the inflows and the outflows of cash. And then also at the end of the period, which is typically the end of the month, we want to make sure that the cash account balance in the general ledger is what's called the true cash balance. And to do that, we're going to use a document called a bank reconciliation. Later in the course, you'll learn how to prepare a bank reconciliation. Now, companies do this every month. They use their bank statement and they use some other information, and they arrive at this true cash balance. The next thing we need to talk about is, what is cash? Well, first, we can talk about anything a bank will take as a deposit, and that's going to include checking account balances, currency and coin that we actually may have on hand at the company, and then also checks on hand, checks that we've received from customers or others. But we also have something called cash equivalents, and we're going to call that cash as well in the financial statements, on the balance sheet that is. So cash equivalents are, as it says here, very liquid, safe, short-term investments. And what do we mean by all that? Liquid simply means that they can be easily converted to cash. Safe means they have little risk of losing value. Short-term means an original maturity of 3 months or less. And so examples of cash equivalents would be U.S. Treasury bills, certificates of deposits or CDs, and also certain kinds of money market funds. We can take a look at where cash is reported in the financial statements, and we're always going to see cash on the balance sheet. And typically, it's going to be the very first asset that is listed. In the previous slide, we talked about that cash equivalents are very liquid, so they can be easily sold, easily converted to cash. And in this asset section of the balance sheet, typically, assets are recorded in the order of liquidity. So cash is going to be the most liquid asset. Coming down from that, we have accounts receivable and inventory, which are less liquid. So this is where you can expect to see cash on the balance sheet.